Greetings, everyone. This is my first day back in the office after 3 weeks away on vacation in part of Asia and Europe. And it looks like I missed some exciting markets in the last 3 weeks while I was away. If you're watching this on YouTube, just a note that this pertains to my monthly e-newsletter, which you can subscribe to by going to www.muhs.ca/newsletter. When you do so, you'll get a couple of introduction emails and then should be on the list for next month. If you want to receive this month's e-newsletter, just send a reply to one of those emails that you're going to get, and I'd be happy to share this one with you. So I've mentioned this before. I started my career in 2008, right before the great financial crisis. So yeah, great timing for me. And with that, I've been through a number of turbulent time periods in the markets that is becoming almost routine. Thinking back to around 2010, still fairly early in my career, a lot of the worst was behind us from the great financial crisis, but we still continued to see some pretty choppy markets. That culminated in a big drop in 2011, the summer of 2011. That was a time when the world was worried about the European debt crisis, as well as the debt ceiling issues in the US, and worries about a double dip recession. In total, the S&P 500 was down about 20% that summer to about September 30th at the worst point. I remember seeing the S&P 500 falling from about in the 1300s to about 1100s. TSX likewise dropped from about 14,000 to 11,000. So that was pretty stressful. And I keep thinking back at, looking at those red numbers, the stress of seeing my own portfolio down a lot. And of course, the stress of seeing my clients' portfolios in aggregate down by quite a bit. By that point, I had already accumulated a fair bit of number of clients and tens of millions in terms of total client assets. So those can be some scary numbers. And of course, there's the challenges of communicating with clients at that time when everything out in the news is telling you it's time to stop the bleeding. When we look at these numbers now, again, thinking of those numbers in the S&P 500, currently over 5,000. Back then, 1,300 to 1,100 seems pretty inconsequential, does it not? And in fact, no one's retirement today is 20% worse off because of that 20% drop in 2011. Likewise, when the markets dropped in 2018, the last time Trump had a tariff tirade, that also didn't put anyone behind 20%. The truly wonderful thing about the stock markets and investments that hold stocks, mutual funds and ETFs, is that they provide daily liquidity with daily pricing, sometimes even pricing to the minute in the case of individual stocks or ETFs. And that's a good thing. You don't get that with other investments. You can't go to your bank. Generally, you can't go to your bank and ask to sell that GIC you hold unless it's a special cashable GIC. If it's not, if the bank is going to give you the option to sell it, to cash it in, they're probably going to give you some sort of a punitive penalty to cash in that GIC early, and it generally doesn't work out in your favor. Likewise, I can't sell my house right now at this very moment, April 23rd at 11:56 a.m. Certainly, I would not, even if I sold in the short term, I would probably not get fair market value to the T. But in stocks, we can do that. We've got that visibility of what they're worth exactly at this point in time. Right up here, S&P 500 at this time, April 23rd. That's showing 1:06 p.m. Eastern time, 5402. That is what the value was at that exact time when I last refreshed this page. If you really wanted to, either because you needed the cash or just couldn't handle the volatility any longer, you had the option. You could have sold all of your stocks or your equity investments on April 8th when things were at their lowest and when things were at their scariest. You have that option. And again, that is the privilege you have with stocks, that any time between 9:30 a.m. Eastern time and 4 p.m. Eastern time, 3 p.m. cutoff with mutual funds, you have that ability to sell. So getting back to my earlier point about that 20% crash in 2011 or 2018 and how it affects market values today, it simply doesn't. Likewise, any type of drop we see in the markets today has no effect on what the market values are 5 years from now, 10 years from now, 20 years from now. What affects the market values at that time is whatever the markets are doing at that time, whatever the business data is showing, the economic data, and the geopolitical going-ons. In the same way that whatever was going on 7 years ago or 14 years ago, that's in the past. And it's today's tariff tirades that are affecting the market. In particular, today the markets are up because it looks like Trump is not going to fire Jay Powell, which is being treated as good news by the markets. But again, day to day, news changes, and that's what affects the markets. And what affects the markets on April 23rd, 2035, who knows exactly what the geopolitical environment is going to be at that time. That's stuff we cannot predict. And just as a drop in investors' accounts back in 2011 did not mean that money flowed out of their accounts, flew away, never to be seen again, likewise, a drop in the markets today does not mean that you are necessarily put behind on your goals for your retirement or whatever your goals are in the future. It simply is a function of this super liquid, super transparent market that we all get to take part of. And while that's a nice benefit of the stock markets, it's also a bit of a downside because we fixate on the here and the now, on exactly what's happening right now in the markets. If we fixate on just the very short term, today, at some point today, even though the markets are up fairly strongly, the S&P 500 was 2% below its high of the day. So yeah, again, if I just looked at the markets minute by minute, hour by hour in the day, that could probably make me feel kind of negative. We zoom out a bit. And again, here we're looking at the year to date, and markets are down 8% year to date, and more, certainly more if we looked at where they were at the high points in February and January. Zoom out a bit, the 1 year return on the markets, well, we've got a pretty decent 7.5% return over the last 12 months. Showing you an actual investment that I myself own and some of my clients own as an example only. This is an investment that's only appropriate for people with a certain risk tolerance level, but this is a globally diversified fund. And if we fixate on just the year to date, yeah, it doesn't look so great. We're down a little over 5%. Certainly, if we looked at that really short term, also not great. I myself, on April 8th, when the markets hit their low point, I remember I was touring the city of Bukhara, Uzbekistan, reliving the history of the Silk Road and the wonderful architecture from that time and the Timurid dynasty and the Emirate of Bukhara. I was also 11 time zones away, so I didn't have the luxury of even being awake for when the markets were open. So I couldn't really see what was going on during the day, and luckily I did not stress out about those things. Again, we zoom out a little bit. Over a year, the globally diversified portfolio had a 6.7% return. 3 years, they annualize at a pretty decent 7%. Now, most financial plans, we actually use return expectations a little bit lower than that. 5 years certainly looks quite a bit better. In 10 years, incorporating a couple more drops in the markets, we had a 7.6% annualized return. So if the short term really troubles you, zoom out. It's also important to realize and keep in mind that in this super liquid, transparent market that is the stock market, there are many millions of participants, and not everyone is participating in the same way with the same goal and the same strategy. While you and I are concerned with what our investments do over the next 10 years, maybe 20 years or longer, there are people who are participating for the day or even for the hour. They're the ones who the financial noise networks are catering to with their minute-by-minute, hour-by-hour updates. So certainly if you are trading day by day, hour by hour, maybe you're using some sort of leverage in a margin account, buying options, you have the potential to make a lot of money in the markets. If you had the foresight on April 2nd, when the markets actually closed up a little bit towards the end of the day because people expected the Trump tariffs announced that afternoon to be less bad than otherwise expected. If you knew what was going to happen, you could have shorted the market and made a tidy sum the next day when the markets plummeted, or the next couple of days. If you happen to know that April 8th sometime was the bottom, you would have done really well to make a big leverage buy in the markets or buy a call option for the next day, April 9th, and you would have seen a very nice return that day. But that's not us. We don't have that crystal ball. We don't want to take that risk because both of those bets can lose a lot of money if they go the other way on us. We simply know that owning the great companies of the world, owning a big basket of them, U.S. companies, Canadian companies, international companies in other parts of the world, that is what has stood the test of time and will continue to in the future. I brought up this matrix chart a number of times. Those of you who are longer-term newsletter subscribers will recognize it. And I'm actually including a PDF version of this in the latest newsletter as well. And this too is to help illustrate the short-term versus the long-term. To illustrate that, yes, in the short term, we see the red rectangles on the edge here. These are 1 year numbers. If we were looking at just the 3 months, we're in a red box right now for the last 3 months. Not so good. Whether or not this year actually turns out to be another red box on the diagonal is to be seen. And there's another chart in the newsletter as well that shows how there can be vast differences between the maximum intra-year drawdown of the markets and how the markets actually finished the year. Good example being 2020, when we remember the markets were down quite a bit, 35% at their worst extent in March of 2020. But they actually finished that year up. What did they do in 2020? They were up about 24%. This is the US total market. So this year, while they're down year to date by -8%, they had a maximum drawdown on a closing basis of -18.9% on April 8th. How will the year finish? We have no idea. And with all this volatility, I want to remind you again to tune out the noise, direct more of your attention to the articles that I'm sharing in this newsletter, to the various authors of those articles, videos, and podcasts. Watching the financial noise networks will not make you a better investor. Quite the contrary. Subscribing to Morgan Housel's podcast, as an example, or reading David Booth's articles will. A financial plan will also help you reach your goals 10, 20, 30 years hence, while trying to time the markets based on whatever is going on in the news right now will most likely derail your plan. Lastly, I include a warning in this newsletter in my section on bad financial advice. Even though I still feel like I started my career just yesterday, I'm realizing I'm coming up on 20 years now since I started advising clients on their investments. And I've seen this cycle numerous times, not just the market cycle, but also the product cycle, what this market churns out regularly and will again and again in the future. This next stage of that cycle, now that we are in a heightened stage of volatility, we're going to see a lot more financial products advertised to you or put before you by financial advisors that'll have you questioning the time-tested advice of owning the great companies of the world by low-cost index funds or relatively low-cost managed funds, and instead owning higher-costing products, alternative investments, structured products. Market-linked GICs will once again be popular at the banks because people want to own something that can at least guarantee them their principal with a little bit of market exposure. I've covered them a number of times in the past. I have a blog post on them. They are not appropriate for anyone. Likewise, principal protected notes and other structured products will again come to the forefront. I don't want to go over all the details on how these work, but the general advice is they are not appropriate for anyone. If you need low risk, if you want to reduce your risk, look at your asset allocation. Maybe GICs are the right investment for you. But these various high-cost products that this industry is going to churn out, they will become more and more popular in the next little while, always at the worst point when the markets are at their lowest, when you're curtailing your potential to maybe recoup your losses. This is why my newest terrible investment advice section goes over something called volatility laundering. To a less pernicious extent, investors may also be tempted by other products that are not quite as bad. They'll be drawn to various actively managed products, higher costing products that have words like low volatility in their name, retirement, or promising some kind of an income yield. Same goes for products like buffer ETFs, not much different than those market-linked GICs that I mentioned, black swan funds, and covered call products. Tune these things out and stick to your strategy. Investing in gold bullion also looks really attractive right now. Gold is at an all-time high, and those returns on gold in the rearview mirror look fantastic. It's strange, though, nobody was talking about that 7 or 8 years ago when gold prices were kind of meandering along and nobody was really that interested in them. Anyways, email me if you want a second opinion of any of these types of products, if they're ever put in front of you by an advisor or if you see them advertised on the financial noise networks. On that point, my evergreen advice on that is any and all investment products ever advertised on television or on billboards should be avoided. The right investments don't need to be advertised. The right investments are either the lowest cost investments or the ones put in front of you by a good financial advisor. And usually because those are lower costing products that have a lower profitability to the product provider, they can't afford the expensive advertisements. So one last thing, for my next newsletter, I want to include a new section called Question of the Month. And I encourage anybody who's getting this video or the newsletter, please contact me in some way, either reply to the email, post a comment on the YouTube video, or otherwise tweet at me or contact me in some other way. You can find a contact form on my website. Ask me anything. Ask me any financial question. I'll look through the results that I get, if I get any, and pick the best one to feature as my question of the month next month in my May newsletter. So anyways, for now, let's hope we see some calmer markets in the future, and I will return to you next month. Take care.